Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, this past weekend's meeting with the Chinese and U.S. presidents didn't make the type material headway on trade negotiations people had hoped for, but nonetheless, to put things simply, they've put talks back on the table, and that news lifted stocks yesterday, and the S&P closed at 2964, its highest close ever. The dollar actually rebounded nicely yesterday, leading to lower moves across the precious metal space. And the U.S. 10-year Treasury continues to sit in and around the 2% level. So as far as what we're going to do today, we're going to start off by looking at S&P sector performance to take a look at what's changed. And then we'll also kind of do a deep dive into financials, and I'll kind of tell you why we're going to do a deep dive into financials. And we've got a bunch of stocks here to look at this week. These are all the biggest cap names across the S&P financial space. So we'll try to get to as many of them as we can as we go through things. But let's start things off by taking a look at the sector performance. So what I've done this week differently than I've done in the past, instead of putting up the chart that, let's say, we normally see on the right-hand side, and of course this comes from StockCharts, it's a performance chart, and of course it's a very good way to quickly look at relative performance to the S&P year to date. So I set the date back to January 2nd. It defaults to 200 days, so you have to kind of have a rough guess of how many trading days there have been in the year and then work your way back to January 2nd. So I think we're somewhere around 125 trading days or so, but again, you can adjust that. But what I wanted to do this week was also put up last week's slide from last week's show. So this was as of last Monday's close versus this Monday's close. And I think this is a real good way of quickly being able to look at what's changed. And when I take a look at this, these two performance charts side by side, looking at the right-hand one as being the most current, there's a couple of things that really stand out that get me interested in changes going on in the market. The first is, if you look all the way on the right-hand side, look at the real estate sector's outperformance at 4.72%. So it's still nicely outperforming the S&P, but look at where it was last week at 8.42%. So this gave back about 370 basis points of outperformance in a single week. So that's kind of a big move. And you look at, okay, so what's the implication of REITs giving up that much outperformance? Why would there be so much selling in the REIT sector, which is typically a high yielding sector and where people go to when rates are low? So that's the first thing I kind of think about. Also take a look at the third bar from the right-hand side. We'll call it, the brown colored one. And that is utilities. So last week, utilities had been outperforming the S&P year-to-date by 1.78%. And a week later, they're now trailing the S&P by 2%, which also means they had a really poor week and gave back also about 3.75% over the course of the week relative to what the S&P had done. And the last thing that sticks out to me here is here, actually, there's one more thing. Notice that healthcare in the orange bar has again crept past, the energy space is now again being the worst performer of the year. They're both really bad, but healthcare had a bad week, and energy actually gained some outperformance last week to just be less of an underperformer on the year. So the teal colored bar now shows about a 7% or 7.2% decline versus 7.8 the week before. So it picked up 60 basis points of performance. And then on the far left side, notice, and this is the implication that I want to get to, is if REITs came off significantly in performance terms, and utilities flipped from outperforming by almost 2% to underperforming by almost 2%, And financials have picked up some outperformance in the last week. There's a rotation going on in the market that you need to be aware of, which is, to me, this shows that there's an underlying belief in the institutional community that rates are not going to go substantially lower. Because if they did, they would still stay in the high yielding space of utilities and REITs. And the fact that in this past week, there's been such a dramatic decline in performance of those two areas and an increase in performance in financials says to me that the marketplace believes that rates will not go much lower, and therefore there's a rotation out of the higher yielding sectors, and there is a push, at least some, into the financial space. And that's why we're going to look at financials this week, because maybe we can come up with some ideas of some names that are getting breakouts or have bottomed properly and are starting to show rallies in order to look for possibilities of what to buy. So let's switch over to our charts now, and we're going to start going through that list of names to look at over the balance of time that we have. So let's start off with the granddaddy of them all is JP Morgan. This, of course, is in the major banking space. And so what I've done here, all the charts we're going to look at will default to weekly charts, but I may flip to a monthly or something if it serves purpose. So what we can see here, going back to 2018, is that there have been 3 definitive peaks, all lining up with sequential upside exhaustion signals. So again, for those of you who may be tuning in for just the first time, the sequential model is one that looks for exhaustion of trend. It identifies that by getting a 13 count, in this case above the price action, which means it's looking for upside exhaustion. And you can see that these signals over the last year to year and a quarter have really been kind of perfect in identifying where JP Morgan has trouble. And all these tops come into the 115 to 120 range. Notice the horizontal dashed line or dotted line up at 127.5 that I've highlighted in yellow in the red box. That is the stop out level to these 13s, essentially meaning that if the stock can properly get above 127.54, then these 13s fall to the wayside and you've reinitiated a new uptrend, similar to what we saw in 2017. So that's the stop out level. So if you're long, I can't say I'd be a buyer right here. We're already on a 10 count towards the next 13 count. So if I'm long, I stay long. And if I can, here, let's put up, let's say, all right, you're going to cooperate. Let's try. There we go. All right. To me, well, at this point, there's 2 levels of significance. One is that we stay Friday closes above 110.10, but again, you've seen we've broken beneath them before. So there's a rule we talk about, a qualified and confirmed break of 110.10. This is a rule that Tom DeMark created in order to up the odds that a break is actually a true one. So even though we've broken beneath this on several Friday closes, this line still draws itself as being significant because we never broke it the right way. In the know trader subscribers, this is something we talk about all the time, and you guys know much better and understand how a qualified and confirmed close gets a breakout or a breakdown. So that's something that subscribers have better understanding of. And what I can tell you now is the 2 key levels are kind of this 110.10 on Friday closes, and then I'd say likely the trend line down to 98.60. Staying above there, you're good. Getting beneath there would increase the chances that you have a more significant top. MACD is pushing, didn't cross, and is starting to spread out again. It's not a buy signal. It's already in a buy signal from back in January. It just says that momentum is starting to pick up again to the upside. So that's JP Morgan. Let's take a look at Bank of America. which that is not. BAC, here we go. Not nearly as strong as JP Morgan. Also has the 13 signals. You've got to get above 35-ish or so to really get a breakout to the upside with a longer term target at 44 3/4. I want to see this stay above kind of just around that 26 level. And in fact, here, if I draw a trend line, let's just take a quick look. All right, so that's 25. So somewhere probably, as time goes on, the trend line, which is now at about 25, moves higher. Somewhere between 25 and 26 is pretty much what I want to see hold on declines. MACD is about to get a new buy signal, so that's good too. So I remain long. I've been long this name myself for, I think, 7 years. No, actually, I bought it in 2008 or 9, so it's a good 10 years already. And I continue to hold this. I think ultimately the banks will do okay. But there is obviously concern in the marketplace over the last couple of years that rates are not going to help the banks much, and that's what they generally need. Let's move on. Wells Fargo. Now, we know this one's going to have a very different look, and it certainly does. It's not near the highs, but take a look at this. Let's take anyone here. We'll go back. So we go back to 2016 and look at how many lows we have somewhere in that low 40s level. More importantly, is that you've recently gotten 213 downside exhaustion signals that have been confirmed. That actually is a good thing. And if you're interested in getting into the stock, you at least have a sense of what you need to risk down to about the 40 level. Upside targets are 54 and 59 if this thing ever recoups. But at least you do have downside exhaustion signals in place now. So that gives you a reason that you certainly could be a buyer. Notice they came together back here in 2016, and that kind of marked the low. Okay, Citibank. Getting closer to also its all-time highs. This up here are all-time highs. So it's been edging higher. You do have an uptrend line here, so certainly we can draw this as the most recent uptrend. I want to see Friday closes stay above this level here. This propulsion level is 63.67. Again, where is it? It's actually 63.87. As long as we don't break beneath this on a qualified and confirmed fashion, this is good. And over time, we can actually establish an $85 target, which is new all-time high. So there's going to be some resistance near 73 from this TDST line. Again, for those, TDST line comes out from the highest high when you do a 9-count down, and when you do a 9-count up, the lowest low is the TDST line. So we've got support here in the mid-50s. Higher support, it's just beneath 64, and then some resistance here at 73-ish, and then ultimately, I think this could get up to 85. So same thing, I like the MACD starting spread out again and giving some upside momentum. Let's move now towards more regional type banks. Here's PNC. This also, maintaining its uptrend. Let me get rid of this line because that doesn't mean anything. 13's on the tops. We've broken. You can in your head, and I guess I can do this quickly here. Kind of draw a downtrend line. Obviously, we've broken above that. So we're close to. I'm just eyeballing this. Probably near a 50% correction of the decline here. MACD is still kind of spreading out in the right direction. So we've got a short-term upside target at 141 and small change. Getting through that ultimately says we can probably test near the highs in the mid-150s to low 160s level. So again, I kind of like it. And as long as we stay above 126.62 on Friday closes, and again, if we break underneath, it would have to be in a qualified and confirmed fashion. Otherwise, it's that would be my breakdown point now, because if we get through that properly, it suggests we're going to retest the lows from December. So this is important to me. This 126 and change level is an important level. What else we have? BB&T. Similar looking chart, about, well, actually a little short of halfway, I'd say, up towards all-time highs. Not as definitive a MACD signal at this point. This to me kind of remains a hold. If I look back here, these highs here caught the lows in the middle of 2017, the December lows here. So there is, look, you can see somewhat of a head and shoulders type of pattern. The pattern would have to really kind of break the December lows to think that we could come back down towards the, do a full correction all the way down to the 2016 low. I'm not anticipating that happen. So this is a hold. You could even nibble on it a bit. But like many of the banks, they're still going to have overhead resistance. So I think these are pretty much holds. SunTrust, STI. Similar look, exhaustion on the top. Look at 2017. You get these exhaustion signals. And again, that doesn't mean the market has to go down. It simply means the trend that's been underway is likely changing. And for a full year, this did identify a sideways market. And of course, sideways is a change in trend from what had been uptrend. So they were good signals. It then pushed to the upside. And then in 2018, we get two different weekly signals, one being on the all-time highs. And then, of course, the sell-off into the fourth quarter and the recoup since. Here you can see targets are at 68 and small change, and then a test of the highs. Don't want to see us break beneath 59 point, well, roughly 60 unqualified and confirmed closes. Otherwise, that would suggest a move down to, what did we say, 60? That's all the way down here at 52 and 3/4. So the 60-ish level is pretty darn important at this point for SunTrust. Here, let me see, BRK. No, I'm trying to see if it's slash. It's not taking either. Maybe it's just BRKB. There we go. Okay, Berkshire Hathaway. Close to all-time highs. Getting a 13 signal last week. We're in the middle of a new count, which means I'm certainly not a buyer here. I can let this count play out. Propulsion says that this should ultimately target 231. But given that we're staring at a 13 right now, I'm not a buyer. If I'm long, I hold it. This has obviously gone nowhere for the last year and a half. And I'd say that I'm looking at like there's one level here, something that we can really hone in on. I'd say that's probably your best trend line. So you're going to want to see this not take out the recent early June low. If we get under there, you've also broken the trend line. So again, a hold, but again, momentum starting to work in the favor, but not something I can buy right here. American Express. So Amex should be, this is all-time highs this week, similar to the S&P. Again, we're staring at a 13 count. That makes it very difficult to be a buyer here. I want to see, same thing, early June low hold. I don't really want to get beneath, let's say, what we'll call it 113.65, the downside propulsion exhaustion level, because if we break through that, then you open the door to get all the way down here at 100. So this is a hold. You can buy on a pullback. If you really like the name, you look to bid somewhere near 120. But you be mindful of, this kind of a stop out underneath the June low. Capital One Financial, COF. So this is definitely more of a trader's type of stock. 13 buy signal here, or again, downside exhaustion, upside exhaustion here. And if it makes it easier, so that's the upside exhaustion. Here's downside exhaustion. The upside exhaustion sells off to a 9 down, which sells off to a 9 up. What's a 9 up? 9 consecutive Fridays that the close is greater than the close from 4 Fridays prior. Notice that we went from the April low all the way up to the January 18 high. So this was April of 17. And it took all this time, but only after it finally made this pattern of 9 consecutive Fridays close above the close from 4 Fridays back did it actually peak. Pulls back, goes sideways. This 13 count is the exhaustion to this 9 count, and then we sell off into December. You do a 9 count down, followed by a 13 in the opposite direction. That's downside exhaustion. It's been straight up since. A Friday close this week above 91.84 that opens higher next Monday and trades above this week's high, gets a new fresh propulsion buy signal with a target of just shy of 98 and then 100.55. So again, a hold, but a potential new buy basis, how we close this Friday and open next Monday. BlackRock, BLK, get into asset management space. So this same thing kind of peaked on a 13 and 9 count. We sell off into December. Since then, we've moved higher. The 9 count here is leading to a higher count. So this too suggests that I'd say this is heading towards 520. I don't want to see it break under proper close. Again, here's a close under 429, but it wasn't a qualified and confirmed one because the week before was a down close. Therefore, that's essentially a support level. So you get one close beneath it, we come right back up. You know, to me, odds say this is going to 520. That's $50 higher, but you've got to risk $50 plus slippage on the downside. So it's if you like the name fundamentally and you think, you know, it hasn't done much recently, you could be a buyer. Technically, your upside and downside are somewhat equal in dollar amounts. But I'd favor trend here as saying that the odds are favored going up as compared to going down. Bank of New York Mellon, BK. So this also showing downside exhaustion here. The 13 and 9 coming about 2 or 3 weeks before the actual lows here, but we haven't bounced much. So this name has a boatload of overhead resistance going back into, I don't know, I'd say it's 2 years worth of resistance because here, let's just pick some rough approximation. Let's draw a line and say that virtually everyone who's been a buyer since June, well, certainly from June of 17 until October of 18 are all losers. You had a minor chance here for a few months, first part of this year, to get your money back or break even, but we've broken down again. This is one of the weakest names we've seen. And unless you really want to bottom fish, I don't think I do it until this broke under 40. So it's trading 44 and change now. That's, you know, I think there's probably still 10% downside or the chance of that. So the only way to really go after this is being an aggressive long. Otherwise, I stay away. Morgan Stanley, my old shop, company I worked for 10 years, 6 of them as chief market strategist. And let's get rid of some of these ellipses. So here too, multiple. Okay, let's go away. Lots of 13s here near the peak. Yeah, we'll just kind of got 3 of them in there. You know, had the rough fourth quarter like everybody else, and it's trying to recover. So recently, in fact, this comes into play this week. Last week was an up close relative to the week before. That means that if this Friday we close under 43.00 and open lower next Monday and trade lower than this week's low, it targets 37.34. It's not a huge move down, but it would be a new fresh sell signal. If we closed right here for the week, and it's obviously Tuesday, too early to tell, but if we closed down on the week relative to last week, then if next Friday's closes above 46.30, the propulsion bullish area, and gaps higher the following Monday and takes out next week's high, then it says we're going to 55, almost 56 as a target. So Morgan Stanley could easily get a new signal within a week or two. And I definitely pay attention to where the Friday closes are and how they are relative to the week before. So again, a down close this Friday relative to last Friday. Then next Friday closes above 46.30, gets you a bullish signal for a move up to almost 56. On the downside, if this week closes beneath 43 even and Monday gaps lower and trades beneath this, anytime next week trades beneath this week's low, then it suggests that we're going down to 37.34. So Morgan Stanley definitely something that could easily come up with a signal any day now. Goldman Sachs gets a downside exhaustion signal close to the bottom in December, kind of been sideways since, still running into some trouble here. You can see now a few times it's run out of steam at 210, tends to find buyers in the 180 to 190 level, still somewhat sideways, minor upside bias just because of the current setup count. And let's just see if we take trend line where that falls. All right, so we've broken above the trend line. So odds favor this gets to 220, but you're really stuck in a range here between 180 and 220 right now. So not much to do. But if you're long the name, I'd hold it. I wouldn't want to see Friday closes under 179.07. That would open the door for a move down to just beneath 150. So that June low is a really important low as far as I'm concerned. The exchanges now, or at least one of them, the Chicago Mercantile Exchange. These guys tend to do well when you get lots of trading and volatility because the exchanges make money. The more trading there's done, they don't care which way it goes. I mean, most would say they want bull markets, but as long as you get volatility and good ample trading, these stocks do well. So we recently made an all-time high about 3 weeks ago or so. We are holding on to same thing here. Let's see, up close, down close, up open this week. That's why we didn't get a propulsion signal. So this is still acting somewhat as support. Same thing in the next week or two, we might very well get a signal, but the target on the signal is pretty small, down at 186, not enough to do. I mean, look at the long-term picture here of just this having been buy and hold over time. And you can see, you know, it definitely can trade, but I like the long-term trend here. So I'm a holder if you've got it, and you look for pullbacks on this to get long. Let me curious what the cloud chart says here. Okay, so the 9 count also came into the cloud just like it did back here in 2015. So the cloud's pretty important. So over the next several weeks, or let's call it over the summer, 175-ish is the bottom of the cloud. That's pretty important because we have not been under the cloud barring 1 week back here in January of 2016. So for those of you who are long CME, pay attention on pullbacks to the cloud and whether or not this level of 175.5 or so holds over the balance of the summer. If it does, it's good. If it's not, I'd probably take at least half of my long-term holdings off. We've got half a minute left, so we got to a good chunk of these stocks. We didn't get to every one, but as always, you know, we try to give the best information we can. In coming weeks, we'll try to get a couple more guests on, and I think that's it. So I am Rick Bensignor. Thanks for listening to In the Know Trader.